monochrome Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider monochrome.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Great to have you with us here at ausbiz. Let's check what happened overnight. Global equity markets edging higher, while the US dollar and bond yields fell. That's in response to a large downward revision to US payrolls data and dovish minutes from last month's Federal Reserve policy meeting. US stocks rose as investors look forward to interest rates being cut next month. Consumer discretionary stocks were among the best performers there. Retail chain Target raising its 24 profit forecast and posting its first quarterly increase in same-store sales in more than a year, sending its stock surging. Discount retailer TJX rose after lifting its annual profit forecast. However, department store chain Macy's lowered its annual net sales forecast, blaming high promotions and weak demand for its clothing and the like, sending its shares sliding. And US-listed shares of Chinese e-commerce firm JD.com fell after the company's biggest shareholder, Walmart, sold its stake in the firm. Ford announced it's altering its electric vehicle plans, beginning a rollout of its next generation of EVs with a commercial van in 2026 while delaying other model rollouts. And the most traded stock on the S&P was Nvidia, with about $33 billion worth of shares changing hands, the chipmaker's shares rising. And US-listed shares of BHP and Rio Tinto followed the iron ore price higher. Well, US employers added far fewer jobs than originally reported in the year through to March. The US non-farm payrolls were revised down by 818,000, which is the largest downward revision since 2009. The employment growth rate was lowered to 1.3% from 1.9%. Meanwhile, FOMC minutes showed that the Fed was on the verge of cutting interest rates at its July meeting, indicating that several policymakers believe that the recent progress on inflation and the rise in the unemployment rate provided a plausible case for reducing the target range by 25 basis points at this meeting, or that they could have supported such a decision. Additionally, went on to say the vast majority said that if the data continued to come in about as expected, it would likely be appropriate to ease policy at the next meeting. Well, Treasury yields fell following those minutes and the payrolls data, the 10-year dipping to 3.79% and the 2-year down more than 7 basis points to 3.92%. And the US dollar has fallen to a more than 1-year low against the euro and sterling. The Aussie trading 67.5 US cents. Well, let's get across that data and how it's moving markets. Ira Epstein joining us from Linn Associates. Ira, good to catch up with you again. Yeah, what did you make of that? I guess the FOMC minutes all but confirming that rate cut next month. Then, of course, you had that payrolls data.
Yeah, well, first, thanks for having me. Sorry I missed everybody last week. Had COVID. My voice is still recovering from that. Yeah, that 800,000 job number. You know, this week we started hearing from Goldman City, Wells Fargo, and a number of other analysts, and they were coming out anywhere between 360,000 to 1 million jobs being lost. And understand, we always get a correction, and one way or the other, up or down, at this time of the year, because the market looks back from April of 2023, but it's always April, up until the end of March, in this case, March of 2024, and it makes adjustments. And then you get a final adjustment at the end of January. So this number, we didn't know what it would be, but when it came out, it was strange because the Bureau, when it came out, didn't release the number. I understand 3 or 4 banks did see it, but nobody else did for about 30 minutes. And when it finally came out, it was a non-event. The market sort of yawned and then it rallied because it realized all it does is solidify the idea that we don't have as many jobs as we thought. we're still in good shape. Understand, even when you lose 812,000 jobs and you smooth it out over those months, you're at about 170,000 plus jobs you're adding every month. That is still a strong economy. But what has been happening is inflation is falling. The tight interest rate policy is taking its toll. The Fed members are now waking up, hit on the head, and they're seeing it. And barring some huge surprise in the PMIs that come out tomorrow in service and manufacturing, then followed by CPI and the August job numbers, I think you look very forward to a minimum of a quarter point cut in September, maybe a half point, depending on how good or bad, depends on your point of view, the jobs number comes in just before that meeting.
In fact, the market's pricing in some 100 basis points of cuts by the end of the year. Is that appropriate in your book?
It is if you want to get ahead of the curve, and it is if the data says that we are seeing the weakening. So this piece of data today did show that we're getting weakening. Now we get jobless claims tomorrow, which we get every week. We'll see how good or bad they are. And remember, this is the end of the summer wind down. So soon a lot of temporary workers are going to be let go from camps and tennis camps and golf places, so on and so forth. We're going to see that. So yes, I think it's more than appropriate. And at some point, all central banks have to get ahead of the curve and not just be data dependent. I do feel pretty good about telling you on this show, 6-7 weeks ago, lock in interest rates. They were 5%. I said, you're going to want that in your portfolio. And this bull run that we're having, be a little bit careful of it. Nothing grows to the sky. It's well anticipated you're going to get that first cut. It wouldn't surprise me you get that cut and you get a break off of it.
Yeah, what do you make of what we've seen on the equity market? Ira, given what happened 2 weeks ago, it's but a memory now, it would seem, as we've pretty much recovered those losses. There seems to be a lot of money trying to find a home at the moment.
Right. And we did get that 10% correction. We did come out of the correction phase, and it all happened so fast that if you went to the washroom, you missed it. And that makes trades like that difficult. It also means that people didn't really get involved in it. And that's typical at this time of the year. Think about it. The Europeans go on vacation in August. Americans, Australians, everybody takes their summer off. We go away the last part, and then we turn our attention to the market back in September. This is what's going on. But there's a lot of other plays that have happened. China pulled a quickie on everybody. In July, they very quietly changed the game for new home projects. Normally, you get a permit, you have to tell the price that you're going to be selling at. Well, without revenues coming in the copper market, and I'm relating to that, without revenues coming in from real estate transactions, they decided to make an experiment and keep it very quiet. So in 10 provinces, they let market factors take over, and we saw a quick drop between 13 to 30% in a lot of these projects, but they're moving. And with that, I've been wondering, why did copper come back so big from 392 suddenly into the 4.25 area? Now you've got it. It's a combination that China's experimenting to find a way to get those projects fixed. They'll need copper. They'll need everything that you can imagine in that. And at the same time, the world's realizing that the world, once the U.S. joins in, basically the G7 has all said, let's cut rates and spur on economies. That's bullish the gold market, that's bullish silver, that's bullish copper. So just be a bit careful. Nothing grows to the sky. The stock market is stretched out. We saw the carry trade unwind, and then suddenly the market just didn't care about that and it moved higher. Nothing grows to the sky.
So, all right, is it your expectation we're going to see the US dollar continue to weaken? And you mentioned gold. Clearly, that has given it support as it continues to flirt with those records.
I've been telling traders that follow my research, I write twice a day research. And if they go to my website, on myname.com, by the way, you'll see that I've been calling for parity in the dollar, for the euro maybe back to the 112, 115 area over time. Most currencies gaining on the dollar. And why not? It's the dollar's time to have some weakness. That's how we'll spur on our growth. And if we're the last one to the party, we're the ones finally saying it's time to cut interest rates when everybody else has been doing so to a certain degree. So yes, I think the dollar's staying under pressure here, which is bullish for the equity market and so on, but nothing grows to the sky. Be very careful. It's like a rubber band. You're pulling on it, and eventually when you pull it too much, you will get a correction. Nothing keeps going forever. We were just at a record. We could have had 9 days in a row up in the S&P. Haven't done that in 20 years.
Yeah, you're not quite the last to the party, Ira. That would be the Australians. Still no sign of a rate cut on this side. Hey, just before you go, what are you expecting, or what would you like to hear from Jerome Powell at Jackson Hole?
I'd like him to say that the time is appropriate now for the U.S. to embark on a less restrictive policy. He's not going to tell you how much they're going to cut. He's not going to tell you when the cut, in other words, is it 25 or 50 basis points. But I think he's going to say the conditions are right, if the data keeps coming this way, that it is time for the U.S. to join the party and have less restrictive interest rates. Code word, rate cuts. Code word, over time coming down. The market will digest all that in the September meeting, and it's over at that point. It doesn't matter how many rate cuts you get. That event has happened, and we've begun the cycle. That's what I'm looking for to happen.
Ira, great to catch up again. Thanks for joining us from Linn Associates.
Thanks, Fred.
Let's take a look at the local market. We are expecting a positive beginning there as we get underway in just a couple of minutes' time. SPI futures up around 1/3%. That's as we, managed to finish in the green yesterday as well. All right, stay with us because the open is just a couple of minutes away.